Always a joy to have you on. I am Pius Kojo Baka. Let's now look at our stories. Fitch Solutions is forecasting that the Ghana cedi would end 2023 at 11 cedis 40 pesos against the dollar. This is lower than the 12 cedis 40 pesos it predicted earlier in the year. At the time, the country was yet to reach an agreement with the International Monetary Fund for a bailout package. Here's more.
The UK-based firm is also projecting 10 cedis 90 pesos to $1 in 2024, fueled by expected inflows from the International Monetary Fund program and improved investor confidence. The local currency is presently going for 11 cedis 53 pesos to the dollar in the retail market and 11 cedis 5 pesos to the American greenback on the interbank market. Since Ghana secured the IMF bailout package in May this year, the local currency has remained relatively stable against the dollar and all the major foreign currencies. Fitch Solutions explained that while short-term exchange rate volatility will persist, it believes that the cedi will stabilize. The forex market was a bit choppy last week as the cedi saw some volatility against the US dollar. This is despite the Bank of Ghana announcing plan to auction $120 million in its forest forward auctions for the bulk oil distribution companies during Q4 2023.
All right, so let's analyze this further. Joining us via Zoom is currency analyst and research lead at GCB Capital, Courage Boutique. For more Courage, pressure, you could join me on Business Live. Would you say this prediction by Fitch that the Ghana cedi would end 2023 at 11 cedis 40 pesos against the dollar is expected? Do you think so?
I struggle to hear you. If you could take the question again.
All right, so I'm asking you to tell us whether you think this prediction by Fitch that the Ghana cedi would end 2023 at 11 cedis 40 pesos against the dollar is expected.
Oh yeah, no surprises here. I think we all know the issues that led to cedi depreciation last year. Even start of year, we saw what the levels were. But beyond January, really, the cedi has been just around the levels they are now, 11.5, 11.6 at worst, and 11.3, 11.4 at some point, really. And it has revolved around that. I think sentiments are a bit calmer now. The speculative pressures are more or less non-existent. In fact, those who bought dollars at 15 cedi, 14 cedi are having the dilemma now whether to sell or to keep and all of that. And yes, things may not have improved so much in terms of liquidity. Reserves are still very low, but the negative sentiment, the bearish sentiment that were triggering the sell-offs, more or less are easing a bit now. And those are the factors supporting the cedi's relative resilience at the current level. So if you look at the fourth quarter where we could expect flows from cocoa syndication, where we could also expect some flows from the IMF later in the year and from the World Bank and the DPO support. All of these should come to pushing the reserve position a bit, and give or take, if we get a successful review later this September for the first review of the IMF program, and given that the fiscal seem to be the consolidation seem to be ahead of target, all of these should inspire some confidence. So you do not expect further deterioration of the cedi, really. At best, it will be stable around the current levels we see them now. And that is what Fitch seems to be saying with this projection.
And it does appears to be a good news, especially at the time when the cedi is going for 11 cedis 53 pesos against the dollar on the forex or retail market, right?
Well, it is a good news. But then again, we need to know where we came from. We came from in 2021, a cedi dollar exchange rate was just around 6 cedis to where it is now. So while closing around 11.4, 11.5, thereabouts would have been remarkable stability, we recorded more than 20% depreciation in just the first month of the year. So end of year depreciation wouldn't have been 0 or even single digit. It would have been 20 plus depreciation of the cedi versus the USD, really. So we need to put it there in that context. But after January, it's been relative stability, which is quite commendable. And that trend should continue. And if we see it that way, and then the food price pressure issues are dealt with, and then the impact of the revenue interventions, the tariff interventions on inflation, if they are dealt with sufficiently, we should begin to see inflation also recede along the year, especially in the Q4, where the base drift effect will be a bit more pronounced.
Of what impact has the IMF contributed? When I say the IMF, I mean the IMF deal contributed to this appreciation we are likely to see at the end of the year.
Well, the IMF gives you confidence. It gives investors comfort and confidence about the economy. And you could see first half of the year numbers as shown in the the half-year review in July, that we are running deficits that are way sharper than what the target for the period was, or significantly below what the target for the period was. We're running a primary balance significantly below what the target for the period was. And you could see a general sense of commitment to fiscal consolidation. Now, that is what the IMF gives you, that credibility to implement your policy, and the assurance that there will not be slippages, at least during the program. And that is what we've seen so far in this first half of the year. It was a front-loaded consolidation. And even if the pace of consolidation will slow down a bit in the second half of the year, generally, it will be a tight fiscal stance. And we have already seen from the monetary side the tightening that has happened. I mean, on the policy rate level, on the deficit monetization angle, and all of these are interplaying to ensure that there is some predictability on the market, which is what investors want. If you are in the uncertain mode with a lot of volatilities, then you will plan for your best interest. But in times of predictability, as we are seeing now, and probably will be under the program for the next 2 or 3 years or so, I mean, you expect that these will feed into the stability of the city and other macro indicators going forward. And that is the expectation, really. So between now and probably end of program, you do not expect the level of depreciation you saw in 2022 or any time in recent times, really. A lot more stability around the current levels is what you would expect.
And finally, could this be sustained going forward? And really, how do we do that? I know you've mentioned a couple of them.
Well, that is where the strength of our reforms count. What adjustments we are doing on the monetary side, on the fiscal side, on the external side, and managing our liabilities, really. External debt restructuring and the interest savings that we stand to derive from that will play a major role in determining whether the cedi remains stable or not. As we speak, reserves are vulnerable. The projection is to end the year with about 0.8 months of import cover, which is not equate. In fact, that's vulnerable. But if we can sustain the confidence as we are sustaining and ensure the reforms gain so much traction going forward, that can hold investors' confidence, I mean, at least until 2026. And thereafter, how we proceed with our economic management will make a big difference. So between now and 2026, we can expect some relative stability around current levels, or even if it's depreciating slightly higher than the current levels, really, but not the levels we saw in 2022. It is after 2026, 2027 that we will begin to see whether the reforms are deep enough and far-reaching enough and can anchor the cedi going forward.
Great. Thank you very much. Courage Boti, Research Lead, GCB Capital, speaking to us there. Still on money matters, banking and financial consultant Christian Tichijan has welcomed government's decision not to touch treasury bills as part of its debt restructuring. Minister of State at the Finance Ministry, Dr. Mohamed Amin Adam, earlier made it clear that T-bills are not part of the scope of debt restructuring program. According to Mr. Tichijan, any attempt by government to touch T-bills will affect government and the banking sector at large. He spoke to Joy Business.
But the Minister of State at the Finance Ministry, Dr. Mohamed Amin Adam, on PM Express denied that government is solely using funds raised from the treasury bills to finance coupon payments of new bonds. He explained that government has been using other sources of funding to pay these new bonds. Now, reacting to questions about government's intention to restructure treasury bills due to growing interest cost and the amount borrowed, Dr. Amin said there are no such plans.
No, I mean, first of all, you know that the T-bills we launched in December was very successful, 85% participation. So if we are reopening for the
program,
yes, it doesn't mean you are doing another round of exchange. You cannot equate that to another round of debt exchange. Okay. Secondly, I've just indicated to you that the cocoa bills and then the US dollar and the alternative pension that we are doing are heading towards a great success. The information we have is that we are going to perform over 90% of that. So if you open even in future, it is for the residual, you know, it's for the few that are left, but not to go around doing another DDEP. As far as the assurances about T-bills, I don't know how many times you want me to, to answer that, but let me just take the opportunity to repeat it. We are not going to do DDEP with treasury bills. Treasury bills must be risk-free. Treasury bills will continue to be a source of revenue for government, a major source of revenue for government, in addition to the other sources that we have. And so people must be assured that we are not coming back to ask them to sign on to anything.
Meanwhile, banking consultant Christian Techi-Jan described the move as one to save the economy.
Government in itself, the governance machinery is going to run at a short, and it means the governance machinery will be grounded, and government cannot afford to do that. We're expecting the second tranche of disbursement from the IMF. That alone is not enough. Government has been shoring up its cash flow with the T-bills, proceeds from the T-bills, and so it cannot afford to do that. And once they want to touch it, already they've set up the sustainability funds, where some commitments have been made by the development partners of the government, as well as some government commitments as well, to help the institutions that will run into liquidity challenges as a result of the domestic debt exchange program.
Some market observers have raised concerns about the amount of funds raised by government on the treasury bill market in the second and the third quarter of this year. Government has been constrained in raising funds after Ghana was restricted from going to the international capital market to raise some monies due to bad ratings. Government is planning to raise about 39 billion Ghana cedis in treasury bill market in the third quarter of this year.
My colleague James Ishen filed that report. Now, Ghana's ability to export more and participate in global trade is badly being affected by access and cost of credit. This was captured in the latest World Trade Report released by the World Organization today. My colleague George Yafe is in Switzerland and has more details on this.
The World Trade Organization's 2023 report showed that banks in Ghana did finance about 25% of the country's total trade. This is making it difficult for Ghana to realize the full benefits that comes from participating in global trade, so as deals that we have signed with some multinationals and developed economies. The report showed that Ghana could have gotten more from these trade deals if they had secured the required funding from these commercial banks in the country. It also came up that there was a high rejection rate when it comes to funding small businesses, so as enterprises that are owned by women. You spoke about trade expansion in Ghana being affected by access to credit and cost to credit. Help me out. Does it mean that Ghana is struggling to get funding for trade? What does it mean?
So that's a very, very good question, and what you have to see is that trade is a very finance intensive business, because all these goods that you ship have to be financed somehow, either by the firm selling it or by the firm or the retailer buying it. And of course, for this to work, you need a developed financial system. And what we've shown in various reports is that it varies a lot by country, but trade finance overall in Africa is not as well developed as trade finance, say, in North America, and that contributes to these high trade costs that we are measuring, and would be kind of fixing this would be an important supply side response to stimulate trade.
And finally, so how does policy measures or actions by government address this challenge when it comes to this trade cost and access being a major challenge to trade finance in Ghana? Should it be a policy issue, or should it be a financial issue, or more of an central bank intervention?
Well, I think you need to really look at the local situation. So it's hard to make, blanket judgments, but the first thing you need to ask yourself, is there some sort of market failure? So is there a reason why perhaps private banks, private financial service providers are not offering this kind of service? And if not, then perhaps step in as a domestic government, perhaps together with the international community. Yes.
From the negotiation room at the World Trade Center in Geneva, this is George Yaffe reporting for Joy Business.
And here in Ghana, I am Pius Kojo Baka. We're taking a breather more. Hello, welcome back. The Institute of Climate and Environmental Governance is raising concerns about the African Climate Summit communiqué, arguing the frameworks and policies leaves much room for improvement. According to the group, the communiqué failed to provide some specific commitments, a balanced approach between adaptation and mitigation, clear plans for resource allocations and enforcement, among others. They are therefore calling on the AU to take into account the diverse regional challenges and ensure greater inclusivity in the decision-making process in order to make a meaningful impact in the fight against climate change in Africa. Let's engage the Executive Director of the Institute of Climate and Environmental Governance, Hamza Suhini, for more on this. Hamza, grateful you could join us on Zoom, and thanks so much for choosing us here on the Joy News channel. Would you say the African Climate provided a workable urgent action plan for environmental protection and economic empowerment?
Very much, and good evening to your viewers out there, and thanks once again for having me on this platform. I think first of all, the point needs to be made that the fight against climate change requires urgent solutions. Not just because of the environmental cost, but largely also because of the health and economic implications, especially for Africa. So there's the need for African countries to approach it with that level of urgency. But unfortunately, characteristic with African politics and governance structure, it appears that we seem to be privileging rhetorics over action. And reading through the communiqué of the African Climate Summit, I think it is quite clear. It's simply a litany of recommendations and call for action directed towards other international bodies and our development partners to a large extent. So for us at the African Institute of Climate and Environmental Governance, our point is simple. There is the need for African leaders to actually take steps to more or less lead the charge when it comes to climate sustainability and as for economic development as far as the continent is concerned. And it is disheartening to state that we cannot say that the recommendations as contained in the communiqué more or less attempted at giving us that confidence that African leaders for the first time would move beyond the rhetorics to actually more or less embracing actionable working solutions that would drive us as far as our sustainability agenda is concerned. So without mincing words, let me say that unfortunately, it has not been so. The climate summit really didn't meet the targets some of us had hoped for. And we are only hoping that subsequently, possibly in the next gathering, action will be taken as far as sustainability is concerned.
All right. Having expressed those reservations, can the African Climate Summit influence business development strategies and investments in sustainable and climate resilient industries across the continent?
Absolutely, yes. And that is what we were expecting. I think, first of all, there's the need for us to understand that one sure way of handling this has to do with policy frameworks and the legal impetus to drive those policy frameworks. So we're expecting the African Climate Summit to come out with timelines as far as African commitments, respective states and their commitments are concerned. Say by 2024, we expect to see African countries coming out with policy frameworks with the needed legal impetus geared towards tackling the sustainability menace in our continent. Unfortunately, that was not done. When it comes to frameworks, it is crucial. It is something we cannot joke with. And we indicated if you look at the national determined contributions of African countries, it has been established that we need about 2.6 trillion between 2010 to 2030, 2020 to 2030 in terms of climate financing, if indeed we need to work on mitigation and adaptation measures. And we are talking about 240 billion US dollars annually that Africa needs to be able to meet up as far as that particular requirement or challenge is concerned.
And
unfortunately, because of poor policy frameworks, we are unable to attract the needed climate finance. So most of our development partners, and even if you like the global north, are quite reluctant because of issues of transparency when it comes to the release of these funds. So before you can attract those funds, there is the need for us to have these legal institutions in place so that they can also be rest assured that they are not just giving us money to spend. We all are quite familiar with the issues of the COVID-19 SDR implementation challenges, especially when it comes to when references is made to issues of corruption in terms of the disbursements in most African countries. So we need to be serious in this particular agenda. We must lay down policy frameworks. We must give it the legal impetus and communicate through our policy actions to the international community that indeed Africa is more than ready to attract that climate finance. And quite frankly, being able to attract it has enormous benefits, not just for environmental protection, but also for economic development. You can imagine what Africa would stand to benefit if we are able to attract even $180 billion annually in terms of climate finance into the economy, into the continent. It's going to improve businesses, it's going to empower us economically and create jobs in the system. There is therefore the need for collaboration. So we need to also enforce collaboration between government institutions, public-private institutions, and our international development partners to at least come out with workable public-private partnerships that will drive investments in as far as renewable energy is concerned. PPPs can result in resource mobilization. It can also lead to what we call risk management to pave the way for even the private industry to take an instrumental interest when it comes to investment.
All right. Thank you very much, Hamza, for your time, Sohini, speaking to us there. And of course, we shall delve deeper in other bulletins as well. That's it for Business Live for today. I am Pius Kojobaka. For more stories, get them on myjoyonline.com/business. Grateful serving you. Do enjoy the rest of our programs. Bye.